Today, we're diving into a real head-scratcher. It's the story of how DoorDash had, well, one of its best days ever, and at the exact same time, one of its absolute worst. It's a paradox, and we're going to unpack it.
Okay, so let's just start here. On November 6th, DoorDash's stock didn't just dip, it took a nosedive. We're talking a 16% freefall, which vaporized over $13 billion in market value. Just poof, gone, in a single day. That's a bloodbath by anyone's standards.
But here is where it gets weird. This crash didn't happen because of some scandal or a terrible business decision. No, this happened moments after DoorDash dropped an absolutely phenomenal earnings report. So what in the world went wrong? What did Wall Street see that sent everyone running for the exits?
To really understand the panic, you first have to understand just how good the news was. Because looking at the numbers, DoorDash's third quarter wasn't just good, it was a home run. Everything looks great.
Let's just run through the highlights. First up, total orders. They were up a massive 21% compared to last year. That is some serious growth in demand.
And to give you some context for that 21%, that's 776 million orders in just 3 months. I mean, just stop and think about the logistics behind that number. It's absolutely staggering.
Okay, now let's follow the money. This chart here shows gross order volume, basically the total cash value of everything people bought through the app. It shot up 25% to an incredible $25 billion. So not only are more people ordering, they're ordering more stuff. A win-win.
But what about profits? The number that Wall Street really cares about. While their Adjusted EBITDA, a key profit metric, was up an eye-watering 41%.
And let's be super clear here. They didn't just meet profit expectations. They completely smashed them. That $754 million was way more than any of the analysts on Wall Street were predicting. And the good news just kept on rolling in. Their main business, U.S. restaurants, was growing at its fastest pace in 3 years. They were adding new users like crazy, almost twice as many as the year before. They snapped up a huge European competitor, Deliveroo, and they were outgrowing the competition pretty much everywhere else in the world. So, more users, more orders, more money, crushing expectations, what gives?
So, with all that good news, why on earth did the stock crash and burn? Well, this is where our story takes a sharp turn. Because the reason for all the panic wasn't buried in the past results. It was hidden in one single sentence about the future.
Right? If everything they just did was so perfect, what could possibly be on the horizon that's worth a $13 billion sell-off?
This right here is the smoking gun, the $13 billion sentence. In their letter to shareholders, they said they expect to invest, and I quote, several $100 million more in 2026. Just let that phrase sink in for a second. Several $100 million more. And what this really signaled to the market was a huge change in strategy. Instead of taking their winnings off the table and enjoying those rising profits, DoorDash basically announced they're taking all that cash and pushing it right back into the middle of the table. They're doubling down.
So, what kind of project costs several $100 million? I mean, this isn't just a new marketing campaign. What DoorDash is planning is a massive, ambitious bet on the future of their entire company.
The CEO, Tony Xu, came on the call and broke down this grand plan into 3 huge initiatives. First, build a brand new global technology platform. Second, launch a whole slate of futuristic new products. And third, digest their enormous new European acquisition, Deliveroo.
Let's start with the tech platform, because this thing is a monster. They're trying to take the tech from 3 different massive companies, DoorDash, Wolt, and now Deliveroo, and merge it all into one single AI-powered system that works across more than 40 countries. If they can actually pull this off, they could develop and launch new features way faster than any of their rivals.
And then you've got the new products, which honestly sound like something out of science fiction. We're talking about commercializing their own delivery robot, DoorDash Dot, building a service that lets any local shop offer the same kind of super fast delivery as Amazon, and get this, a new service that actually brings you to a restaurant, completely flipping their business model on its head.
So you can see the ambition here, right? It's huge. But this massive spending plan creates a fundamental dilemma for anyone thinking about investing. Is this a brilliant move or is it complete madness? Is this a moment to worry or is it a huge opportunity? Okay, let's break down both sides of the argument. On one hand, you've got the believers, the bulls. They say, look, this is just the DoorDash playbook. They build a cash cow business, then use that money to fund the next big thing and crush the competition long term. They see a company focused on the future, not a quick stock bump. But then you have the skeptics, the bears. They're looking at this and saying several $100 million is a gigantic, risky bet that's going to kill profits for years. Merging 3 tech platforms sounds like a nightmare. And we want our profits now, not maybe in a decade when the robots finally work.
DoorDash's leadership pretty much responded directly to those skeptics with this line in their letter. It perfectly sums up their philosophy. We wish there was a way to grow a baby into an adult without investment, but we do not believe this is how life or business works. In other words, they know it's going to hurt, but they believe it's the only way to grow.
So that's the whole paradox. That is the $13 billion question. DoorDash is consciously choosing short-term pain, betting hundreds and hundreds of millions of dollars that it will lead to total domination in the long run. The only question left is, in a market that demands results right now, will investors have the patience to stick around and see if that bet actually pays off?